Eric, it was great to have Alex back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Alex's picture saying, looking for the downloads.
Patrick, after Alex Garevich's comments on Japan, the yen feels like it's sitting at the center of a cross-currents right now. When you look at that setup, how are you thinking about positioning around the yen for the next several months?
Eric, coming out of Alex's interview, Japan is starting to look less like a one-way weak yen forever trade and more like a macro inflection. Yields have risen and the curve has steepened, yet the yen remains extremely weak. When you pair higher yields with a cheap currency, you eventually get a pendulum swing as capital starts to flow back in and the currency can surprise on the upside. So for this week's Trade of the Week, I want to get long yen exposure without pretending we're picking the exact bottom. The setup is asymmetric. If the Bank of Japan stays cautious, the market can still remain investable. But if tightening resumes and capital starts flowing back into Japan, the unwind of the yen-funded positioning can drive a fast move higher. So here's the structure. The September 2026 yen future is trading at 62.20. I'm looking at the August 7th, 6-month, 63 call priced at 37 pips, of which 32 pips is intrinsic value and a delta around 77 cents, getting you a high delta participation. Each contract represents roughly $80,000 of notional exposure, and $4,625 premium outlay per contract buys you convexity and capped risk. If the yen breaks higher, you're participating meaningfully, and if it rolls over, your risk is limited to the premium paid. It's a clean way to express a bullish yen view, positioning for a potential regime shift without taking open-ended downside exposure.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
Eric, we got to talk about these equity markets. What's your thoughts here?
No real change from last week, Patrick. We went from people starting to panic and thinking that the sky was falling to a fresh round of euphoria that maybe the software tech correction seems to be bouncing. The question is, are we going to see a Mag 7 rally? But moving on to the big picture, my view is still that the stock bull market of the early 2020s is in its late stages, if not winding down, while the commodities bull market of the late 2020s is still just in its infancy.
Well, Eric, a lot has happened on the S&P 500 in the last week. We were at the edge of a cliff last week, attempted to break below the 50-day moving average, and the bulls made a big save, bringing the S&P 500 back in this January trade range. Now, what we want to identify here is how things look under the hood. Now, I want to look on page 5 here on the NASDAQ 100. And what you can see here is the NASDAQ broke below its 50-day moving average. And on this recent rally, the NASDAQ has failed to get back above that 50-day moving average. That's really being driven on the weakness in the software stocks we talked about last week. But what's interesting here is that the semiconductors on page 6 continue to do very well. So we have this scenario where Mag 7s and software index continue to do very poorly, but the semiconductors are back up to our 52-week highs, and even the KOSPI and other AI-driven indices are actually making fresh new 52-week highs. Really, in order for that S&P 500 to go higher, it really needs those Mag 7s to turn up. And if not, then this is going to be a very heavy market where rallies are going to be short-lived and overhead resistance is going to be very difficult to beat. And so we're really watching to see whether or not that participation happens, or whether the ceiling has been already formed on the markets. All right, Eric, let's touch on the US dollar here.
Well, last week I said the bounce on the Dixie looked impressive, but I questioned whether it would roll back over, maybe even moving down to new lower lows. after the market realized that Warsh wouldn't be as hawkish as Fed chair as the market feared. The rally clearly has stalled, but we haven't really rolled over to new lower lows either. We're about a 50% retrace level, so this could still go either way. My outlook is still bearish on the Dixie, but I also want to acknowledge that we're fighting a multi-year support level at 95 or so, and so we could easily consolidate here for weeks to months before the next directional move is clear.
Well, Eric, I'm keeping the dollar very simple here. We had a rally attempt. It rejected at Fibonacci zones and below the 50-day. So the prevailing downtrend remains the path of least resistance. The price action's very weak, but we're at a very important level on dollar index at this 96.50 level, because if we break below it, then the downside window really opens and we could see a level down toward 95 or 94 on the dollar index. At this point, there's no sign of a trend reversal and no sign of any bulls ready to take the dollar higher. So at this stage, we want to respect that prevailing downtrend. All right, Eric, let's touch on crude here.
Well, Patrick, I guess I'd put it to say crude oil seems to be firming up, but it's not racing toward a big upside breakout either. I continue to see a tug of war in this market. At least that's my perception of what's driving it. The intermediate to long-term fundamentals are definitely bullish. We're seeing that in the time spreads as well. But in the short term, few things are more important to President Trump than keeping energy prices low through the midterm elections. And whether you like him or hate him, it's pretty darn clear that he's willing to take extreme measures in order to get his way. So I just question whether or not there's a risk around an outright long on the flat price of oil if President Trump potentially is going to make a deal with somebody in order to suppress the price through the elections. Meanwhile, the time spreads continue to strengthen into modest backwardation, and that's still the trade that I favor. And as our longtime listeners know, that's the trade that I've had on for several months now, which is long the CLZ6 Z7 time spread.
Well, my only observation here is that the price action remains surprisingly cumulative. Every time there's a dip, it's bought, and we continue to hold well above the 50-day moving average and at multi-month highs. At this stage, price action has established a new bull trend, and there isn't a lot of narratives around this bull thesis, which would mean that it would surprise a lot of investors if it broke out here. At this stage, I want to respect this short-term bull trend and looking for upside back to the highs that were established in 2025. All right, Eric, let's talk about gold.
Patrick, the main thought on my mind this week is, well, it ain't over till it's over. We're back above the 50% fib retrace level at 50.24 on the April contract. That's definitely positive. But this rally has stalled here right around 5100 a few times now. Seems like we're fighting some pretty strong resistance there, and that's still well below the 61.8 fib retrace level, which is at 5166. And to be sure, after a panic of the magnitude that we saw last week, a dead cat bounce trading up to the 61.8% Fibonacci retracement level. That's 5166, 5166 on the April contract. If we were to hit that level, then roll over in order to retest, let's say first the 50% level, that's 5024, and then going down to 4882, which is the 38.2% level. That would be a perfectly textbook failed dead cat bounce type of a situation. So to my thinking, it ain't over till it's over. Now, if we got a solid daily and then weekly close above 5166 and stayed there for a week, that's what would sound the all clear and say, okay, the bottom is probably in for this correction. But unless we get that move above 5166, absent that signal, I think we're probably going to consolidate for weeks to months in the 4,500 to 5,000 range. So we'll have to see how this plays out. Ultimately, though, I'm still definitely bullish this market. I don't think the bull market is over.
Yeah, well, my position is very simple. After such an extraordinary bull run and such a steep correction, at this stage, the name of the game is going to be consolidation. I think that first quarter of the year now is going to be gold just absorbing this volatility and really establishing a new fair value zone. It's very reasonable to assume that the 50-day moving average and the low that was put in last week down near 4,500 could be the low end of the range. We We've seen previous gold consolidations that the first low that is established is the one that ends up being the lowest level gold traded. So if this pattern persists, then we should see that act as a major support. But it's very likely here that these short-term rallies in gold are likely to be faded, and that we're going to be far more range-bound, and maybe only after several months of consolidation does it set up for maybe bull continuation later in the year. All right, Eric, let's touch on uranium here.
Patrick, I'm still uber bullish in the long term, and the swing trade or correction, whatever you want to call it, that we've just had, cleared out the overbought technicals and has set the stage for a new move higher on the daily chart. Now, the one hesitation I have about that is the stochastics are still a bit high on the weekly chart and still pointed down. So maybe this isn't over quite yet, but the extreme overbought condition on both daily and weekly charts has been negated by the correction, and the daily chart at least is set up for a new bull move higher. I remain uber bullish intermediate to long term, but I'm not sure whether or not the market is done shaking out the weak hands. If the precious metals roll over in particular, a contagion will ensue, not because there's any reason for it to, other than that a lot of the same people own both precious metals and uranium. If they were to get shaken out of their long precious metals positions, particularly if we get a really big, deeper, lower low situation in precious metals, that's going to cause margin calls that will cause people to be forced to sell what they can, not what they want to, and that means they'll be selling their uranium. So that's definitely a structural risk. Other than that, and really extreme events like a major nuclear accident, I just couldn't be more bullish this uranium market. Question is the turbulence over yet? I'm not quite sure.
As steep of a drop as uranium was, it came right to the 50-day moving average, right to the retracement zones, and it's bounced off those levels. So at this stage, the bulls actually are still in command of this trend, and I'm going to give the bulls the benefit of the doubt that they're going to be able to turn this and drive uranium prices still higher from here. Just to wrap things up, Eric, I wanted to just touch on copper. Bottom line is copper has consolidated, but old pullbacks have actually held along the 50-day moving average. At this stage, copper had a great run. It was just like gold and silver. We could very well see consolidation prevail here on the short term. Basically, I'm not looking for another big upside rip here, but rather at the same time, I'm not overly bearish. So I think the story for the remainder of the first quarter of the year on so many of these is just going to be consolidation and backfilling and establishing new fair value zones. And I think that's a very safe way for many of our listeners to be thinking about the prices here.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
That 10-year Treasury yield, we had the first reasonably big move of the year. Things have been very quiet through December and January. At this moment, the big question here is, are we going to see a re-resumption of yields declining after spending basically 3-4 months with yields coming off the 4% level back to about 4.30? We're now seeing that trend reverse back down. Will we see yields back at 4%? At this stage, I wouldn't surprise me. And so watching to see whether bonds get spicy here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You'll find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you all for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.